Welcome to the Midwest first-time homebuyers class. Don't make these 5 money mistakes when you're buying your first home. Presented by Rob Miller, Provisor Incorporated. The presentation itself is going to cover 3 main things: the mistakes that people are going to make when obtaining a mortgage features that can help you save money, options on how to book a time with me to talk more. Few housekeeping items. There's going to be someone watching chat for all your questions coming in, and we will break and have time to answer the questions as we go along, as well as at the very end of the presentation. Down at the very bottom here, and then I'm circling, is a QR code. If you stick your phone up to that QR code, you can actually access all my contact information and save it right directly to your phone. Otherwise, you can see I do have my contact information listed here as well. Let's get going. A little bit of information about me. My name is Rob Miller. I'm a certified mortgage advisor, branch manager, and senior loan officer with Provisor Transparent Mortgage Solutions. I have been doing this for over 20 years now with my company Provisor. We are a Wisconsin-based company, started here in Madison. I'm sorry, I had to invite someone else to the meeting. We were started back in 1998 here in Madison by James Mercado, who is still the president of our company. Provisor as a whole, we fund well over 1,000 loans a year. Things that I believe in. The main skill you should look for in a mortgage company and a loan officer is the ability to solve problems. Our lives have hurdles. My job is knowing how to guide you through those hurdles and solve problems. It's key to obtaining the correct mortgage for your situation. Let's dive right into the first mistake. Mistake number 1, not using a lender who offers all the mortgage options. There's tons of mortgage options available for everyone. And as we look at them, there's different types of mortgage options. We have conventional loans. We have VA loans. VA loans are specific for veterans. You have to be a veteran in order to utilize that program. We have USDA loans. USDA loans are loans for people that are looking at buying properties in more rural type communities. We also have FHA loans that are available for people. As you see, each loan program has different credit score requirements, different down payment requirements, just different loan programs all together. So there are quite a few of these. Few more options that we have. We have WIDA. WIDA is actually a specialized loan program just for the state of Wisconsin. And again, it is a very low to no money down program. We have non-standard loans, or what they call non-QM loans. Non-QM loans are non-qualified mortgage loans. So it's going to help people that have maybe challenged credit, maybe had a recent bankruptcy or foreclosure, or self-employed borrowers that really don't report a lot of income. We also have programs that are set up for people that are looking specifically for an investment property and really don't show a lot of rental history in terms of owning and being landlords. Jumbo loans and adjustable rate mortgage loans are specialized loan programs for people. Adjustable rate mortgages are going to have a fixed interest rate for a short period of time. And then after that short period of time is open, whether it's 3 years, 5 years, 7 years, 10 years, the interest rate could go up, could go down. It's based on the market. Jumbo loans are above and beyond the standard loans in terms of the loan amount. When the loan amount is above a certain dollar amount, and that dollar amount is listed right here at $647,200, when that loan's above it, becomes a jumbo loan, and then there are special programs just for jumbo loans. Different types of homes that are available for people to buy when you're a first-time home buyer. We have single-family homes. Single-family homes are going to count for homes that are just 1 unit all the way up to 4 units, where single families live in each individual location, whether it's a duplex or a triplex. Condominiums. Condominiums are certainly popular here in the Madison area, as well as all over the place. Condominiums are going to be properties that are homes that you're going to buy, but you maybe don't own the common areas, or maybe you don't own the land underneath. You're just going to own the actual structure, the inside structure of your unit. Manufactured homes. Manufactured homes are homes that are built in a factory and then brought to the site, instead of homes that are built right there on the site. New construction homes, people that are buying homes or building homes. And a lot of homes out there right now are turning into the new construction style, because there's not a lot of existing homes that are out there. Investment properties, properties that people are looking to become landlords, or looking to VRBO or Airbnb properties and make some rental income. Vacation homes, homes that you're going to live in, not rent out. Places that, maybe in a more warm climate, whether it's Florida or Texas, Arizona, California, whatever. And then also second homes. Second homes are going to be homes that are going to be a secondary home to your primary home. And a secondary home in areas that maybe are more recreational, whether it's buying a property in northern Wisconsin, or, in another state, which is, maybe on a lake or something like that. Official lending rules versus lender overlays. Now, this is something that's kind of important to look at. Official lending rules are rules for specific loan types: FHA, VA, USDA, Fannie and Freddie Mac. They're going to be the same for every lender across the entire country. They're set. This is exactly what the rules are. However, overlays are different. Overlays are each individual lender can take any particular rule that's out there and decide to make it tougher based on their tolerance for risk. So one lender might be, lender A might tell someone that, no, we can't help you get a home because your credit's not good enough. Whereas lender B may be able to help them because they don't have an overlay with income or with credit. Does anyone have any questions on this section? If you do, please just put it in the chat window. I'll take a couple questions here at this time. At the end, we'll have an extended period. If you don't feel like you want to put something into the chat window, you can certainly email me or call me. You can even book an appointment in my calendar. Now, as you see, I have my calendar link here, but I just put into the chat window. If you want to click on that link, you can certainly access my calendar there, and we can schedule a time to chat. All right, no questions. I'll go on to mistake number 2, ignoring sources available for down payments and fees and prepaid items. Sources that you can use for down payment: your own money, checking, savings, investment accounts, whether it's IRAs, 401ks, money market accounts, mutual funds, anything like that. Excuse me. Even at this point, Bitcoin and some of the other online income. You can use gifts from family and friends, your employer, or even a charitable organization. There are down payment assistance programs, a grant or a loan, that are available for people. It's really going to be based specifically on where the property is located, what you're looking to buy. You can take a second mortgage out on a house that you currently own. So if you are buying a rental property or a second home, you can take a second mortgage on your primary residence to get some money for down payment. Some people sell their current home. They buy a home, they sell it to buy another property. So the proceeds from that sale can be done. Securing a loan on any asset that you might own. Assets being automobiles, guitars, artwork, jewelry, gold bullion. Things that cannot be used for down payment is strictly cash. Any cash that's in the home in a safe place cannot be used as down payment, unless, of course, that money is deposited into your bank account months and months in advance. I'm saying 3, 4, 5 months in advance. let's talk about fees. Closing costs and prepaids are fees when you buy a home. When you buy a home or refinance a current mortgage, there's always going to be costs, just like there's costs for any other purchase in life. When people hear that closing costs and prepaids could be 3, 6, 8,000 plus, most people react saying to themselves, that's a lot of money. And it absolutely is a lot of money. But when you understand what each fee does to help you buy a house, it makes more sense why they're charged. An example, let's compare fees to obtaining a mortgage to something very elementary, buying a candy bar at a grocery store. If you buy $100,000 home and the closing costs and prepaids are $4,500, when you buy a candy bar, you pay 5.5% sales tax. If you bought $100,000 worth of candy bars at 5.5%, it's going to cost you $5,500, which means the fees to buy candy bars are more expensive than the fees to buy a home. I know that sounds simple and silly, and most people aren't going to buy $100,000 worth of candy bars, but when you look at the numbers, $100,000 is certainly a larger number than, the sales tax that you pay on a candy bar. Does anyone have any questions on this section? Please certainly feel free to go ahead and put that in the chat window. If we have a couple questions, I can certainly take them now. Otherwise, we can go on to another one. And if you feel like you'd rather chat with me outside of this, again, I just popped my calendar up so you can link to it. Find an appointment time for us to get together and chat. All right, I'll go on to the next section. Mistake number 3, halfway through the mistakes, not getting a pre-approval. A pre-approval to buy a home is when I, a lender, obtain details about your financial and credit history, your credit report, your income, and any money that you have available to buy a home. The information about each loan type is added to your file, so the information can then be run through a risk software provided by each specific loan type that we talked about earlier. The computer software is then evaluating what your level of pre-approval is. The pre-approval answer is only as good as the information being put into the software. The art of being a good loan officer is knowing the tendencies of the software so you can be guided on what it takes to become pre-approved. A pre-approval will identify what price range of house you qualify for. It will estimate your monthly payment and total down payment or investment into the property. It's going to identify which loan products or loan programs will fulfill your needs. And it's going to provide you with a letter from the lender stating that we've checked your numbers for the house that you're making an offer to buy. That is certainly one of the most important things, and my real estate friends that are out there know that having a pre-approval is going to help you get into a property at a much easier way than if you don't have a pre-approval. Most sellers like to see that you have been pre-approved and you're able to buy their home and you're not just writing an offer. Anyone have any questions on this section? It was a fairly quick section, pretty self-explanatory, pre-approval. Anyone have any questions on what it takes to be pre-approved? Please certainly feel free to send something in chat and I'll answer it as I can. Again, we'll have a much more extended time at the end of the meeting where we'll answer the questions. And as well, sound like a broken record, but please feel free to schedule a time with me on my calendar or pick up the phone and give me a call, or even email me. My favorite section, and part of my job as a certified mortgage advisor, is to talk about mistake number 4. Very important thing to know, and that's not paying extra on your mortgage each month. We have a scenario here, the $250,000 purchase price of a home with a 5% down payment, an interest rate of 6.5%. I know that's a scary number, but that's life it is today. The length of the loan, and each one of these 4 options shows the difference. Doing option 1 you're just making your minimum principal and interest payment, so $1,501. Option 2, you're making an extra $50 a month payment. So instead of $1,501, you're paying $1,551. Option 3, you're paying an extra $100. So instead of $1,501, you're paying $1,601. And then, of course, option 4 is paying an additional $200. Now, the crazy things that you see here is down in the red. Option 1, obviously, is you pay off the loan in the entire length of the loan, 30 years. Just by paying an extra $50 a month, you're going to pay it off in 3 years quicker. Paying it an extra $100 a month, you're going to pay it off in almost 5 years quicker. And then, of course, an extra $200 a month, you're paying it in almost a little over 8 years. One of the things that I always find crazy is the interest that you're going to pay. So if you look here, you have total interest on the life of the loan in the standard option, $302,900. Whereas if you pay an extra $200, you're saving yourself almost $100,000 in interest. You're not having to send that in to the lender. Also, as you go and you look down here, the loan balance after 5 years. You know, a lot of times people own a home for 5 years. It's kind of the standard 5 years ownership of a property. Some people go quicker and sell their home quicker. Some people go a little bit longer. But option 1, paying just the standard payment, you're going to still owe $222,000. Whereas 5 years later, if you pay an extra $200, you're going to have an additional $14,000 of equity in the property. And it gets even bigger and bigger as you go. Any questions on this section? Some really important things. I always like to make sure that everyone understands making that extra payment is going to save you tons of money. If you can't afford to make that extra payment every single month, you can certainly do it as you can. If you can find a way to make an additional mortgage payment of $1,500 over the entire year, so some people call it biweekly payments. If you can make an additional payment once a year of $1,500, you're going to save yourself 3 years of interest. Any questions that anyone has, please feel free to put a question in, whether it's on this particular section or any of the sections that I've gone through to this point. All right, I'll go on to mistake number 5. One of the biggest mistakes and one of the most costly mistakes of all is working with a loan officer who does not understand official lending rules and how to solve or overcome problems as they arise. So working with someone that is not really versed in this and knows and has seen a lot of stuff in their years of work, a brand new loan officer might not know specific information that could be very helpful for you. They might tell you that, oh, you have to do an FHA loan, which is one of the more costly loans. Whereas if you go to a lender who knows, and that loan officer who knows what they're talking about, you might qualify for a different program that's a little less costly. And of course, when you're in the process of the loan, making sure that your pre-approval is really more of an approval. And what I mean by that is, they've reviewed all the information, and if there is any issues that arise, they can address them right away and be on top of it. So working with a loan officer and a team of loan officers like my team at Provisor, my assistant and my processor, between us, we have about 75 years of experience almost. So we've seen a lot, and we can certainly help you. But this is one of the most expensive things that can happen, is not working with a loan officer who really knows what they're talking about. Some other important mortgage information that I just wanted to kind of share with you. One thing that people don't really know about, and most lenders don't bring up, is on this next page. It's called the mortgage credit certificate. or as I term MCC. It's a great program for first-time home buyers, veterans, people in the military, as well as people that are buying a house that don't meet the first two criterias or one of the first two criterias. But you want to buy a house and you have to buy that house in a designated area of HUD. So in other words, HUD has certain areas throughout the country. And so HUD has different areas that they deem is a designated area. And if you are not a first-time home buyer or not a military veteran, you can certainly still qualify and use this program. And so the mortgage credit certificate is a government program that's entered in to your federal income tax return. It's just like the earned income credit that people see when they do their taxes. It's a program that allows homeowners, home buyers to claim a dollar for dollar tax credit up to $2,000 for every year. There is a one-time fee of $600 that's charged and it's paid at closing. That's built into the total closing costs in your cash to close. There are a few limitations other than what were listed above. There's a maximum income limit, and it's going to be varied by county to county. Your household income must be under the limit. And when I say household income, everyone that lives in the household that has any sort of income, everyone has to be over it, underneath that number. It can be used with all the loan types that we talked about, anywhere from a conventional loan to a VA loan to a USDA loan. My computer's acting slow. Sorry about that. Non-market things that affect your interest rate. So your interest rate is based on a lot of different factors. One of the primary factors that makes up your interest rate is, of course, the market itself. But there are other things that do make up your interest rate. When I talk about the market, I'm talking about mortgage-backed securities and just kind of like the stock market in a way, but a different version. It's called the bond market. But things that are not related to the market that affect your interest rate are, as listed here, your credit score. The higher your credit score, the lower your interest rate. How much you're putting down. The larger down payment you have means that there's less risk for us as a lender. So that means when we have less risk, we have slightly lower interest rates. The particular type of property, owning a manufactured home versus buying a single family ranch, that is going to be different, as well as it says here, investment properties are second homes. The greater the risk, the higher the interest rate. And generally speaking, condominiums, manufactured homes, investment properties, and second homes, they can be riskier for us as a lender, just in general. Actuarial tables tell us that. But as they are a little bit riskier, we relegate our risk by having a slightly higher interest rate. Mortgage insurance. If you're not putting 20% down when you buy a home, there's a good chance that you're going to have mortgage insurance. And the mortgage insurance can actually provide you with a lower interest rate. And the reason it is because we have an insurance policy that's protecting us in case of foreclosure, which again reduces our risk. The loan amount, how much money you're borrowing can cause the interest rates to be higher or lower. The higher the loan amount, the lower the interest rate can be. And that's simply based on the fact that at a higher loan amount with a lower interest rate, we could still potentially be earning more interest and make it more profitable for us as a lender with that higher loan amount. So the lower, generally speaking, has slightly higher interest rates. The number of years that the loan's going to last. So a 30 years loan is going to have a higher interest rate than a 15-year loan. And that's simply because of, as it says, the longer the time frame, the more the economy is going to influence and affect our profitability on the loan. So of course, a 30-year mortgage is going to have a higher interest rate. But of course, a 15-year will have less. When you look at the payments, that's the toss up. What makes more sense, whether it's the payment or the higher interest rate. The length of the interest rate lock. So how long we have to lock the interest rate in before closing is going to determine the interest rate itself. The longer the lock, the more the economy is going to impact the ability for us to have profit or profitability of that. Parts of a mortgage payment. Principal, interest, fairly simple. Principal is the amount of money that you're borrowing. The interest is the fee that we're going to charge for you to be able to borrow that money from us. Home insurance. Home insurance is simple. It's going to protect you against damages like fire, theft, and some weather. It's also going to protect the possessions inside the home. Property taxes. Property taxes are a tax on the assessment of the property. It's going to help pay for schools and libraries and the government infrastructure. Mortgage insurance, if you're not putting 20% down, mortgage insurance is going to be an additional part to the payment. If we have to start a foreclosure, again, the policy is going to protect us, or a portion of it is going to protect us for any of the expenses that we're going to have. Condominium association dues. If you're buying a condominium, generally speaking, you're going to have condominium association dues. And that is something that you need to add to your total mortgage payment. Flood insurance, if needed. If your home is in an area that is deemed by FEMA to be in a flood zone, you're going to need to have flood insurance. Now, your regular home insurance is not going to cover that damage. Down in Florida, the stuff that happened, anyone that didn't have flood insurance, the hurricane stuff, none of that was covered. So pretty much everyone down there has to have flood insurance. Let's talk about the costs. I mentioned at the beginning some of the costs that are going to be involved. Closing costs are one of the fees that are going to be incurred by you to obtain a mortgage. We're going to need to have an appraisal fee. We're going to have to process the loan. So there's costs in which to do that. If you're in a floodplain, we may need to get a flood certificate to determine whether or not you're in that floodplain. If we want to get your credit report and combine it into one report, there's a fee in which to do that. Verification fees. If we need to verify employment, or you're purchasing a condominium, there can be a fee for that. Title closing fee. It's going to be a fee that you're going to pay to the title company to prepare all the closing documents and close the sale for you to buy. Lender's title policy. It's an insurance policy for us, the lender, that's going to ensure that the property the mortgage is on is free of other liens, meaning there's no other judgments, liens, child support, anything like that that's attached to it. Government recording fees. There's going to be 2 fees that you're going to pay to record the deed and the mortgage with the county, showing that you are now the owner of the home that the mortgage is also listed on. Discount points. Discount points are fees that they're going to be charged if you were to choose to buy down your interest rate to get a lower one. There are options in which you can do that. I'm going to go into greater detail in the next slide. There could be other fees that are out there. It's going to depend on your personal financial real estate transaction. So let's talk about discount points. Discount points, or just points in general, are going to lower your interest rate in exchange for paying an upfront fee. So instead of us collecting it over the life of the loan, we're going to collect it up front. A lender credit is going to lower the opposite of a discount point, is going to actually give you a credit and lower your closing costs in exchange for accepting a higher interest rate. So in other words, you can get into a home without having as much closing costs if you want to have a slightly higher interest rate and pay it throughout the life of the loan. You'll see this, people will talk about they have no closing costs and no fees and stuff like that. Well, that's because their interest rate is actually higher. Points will let you make a trade-off between your upfront costs and your monthly payments. If you want to have the lowest payment possible, paying points is going to be the way to do it. If you plan on staying in the property for a long time, points are going to help you get the lowest payment possible. A lender credit for that higher interest rate is going to help you if you don't see yourself living in the property for a long period of time and you want to have less upfront costs. Prepaid costs, another fee, but their costs are expenses that are paid in advance of when the money's actually due. So there are 5 fees potentially that are going to be there. The first is going to be daily interest. Now, based on the date of your closing, you're going to pay interest from that day of closing until the end of that same month. That's going to be built into the purchase of the property. Now, it allows you to skip that first mortgage payment that following month. So I'll use the example, you're closing on the 25th of November. Well, there's going to be 5 days of prepaid interest, daily interest, that is going to be charged. Now, you're not going to have a mortgage payment December 1st. You're going to have a mortgage payment January 1st. Another prepaid cost, home insurance. You're going to pay that first year in advance. We want to make sure the house is covered in case there's a fire or some sort of damage, wind, whatever. Flood insurance, if you're going to be determined the property that you're buying is in a floodplain, we are going to require that you have flood insurance, and you're going to pay that first year's premium as well. Then there's other prepaid costs, an escrow account. An escrow account is an account that's set up almost like a checking or savings account. And that is going to be set up to help pay for the home insurance and the property taxes when they come due the following year. So when we set up an escrow account, we are always going to make sure there's a 2-month cushion in that account so that you're not short when they come due the following year. So home insurance is always going to be due the same day as closing. So again, if you close on the 25th of November, you can expect the 25th of November of next year that you're going to have homeowners insurance due. Property taxes, those are going to be paid once a year. They're due at the end of January in the state of Wisconsin, January 31st. But most people pay them before the end of the year. Another fee, if applicable, is condominium dues. You're going to pay that first month in advance. Potentially, there's some other fees that could be out there. And it's going to really depend on the type of real estate transaction. How can you pay for those fees? It's very similar to down payment, but there are some extra options. Of course, you can still use your own money. You can get a gift. Down payment assistance is always great for paying costs. Second mortgages, selling property. Again, you still cannot use cash for paying for the closing costs and prepaids. But the other 2 options that you have is you can ask, when you make an offer on a property, you can ask for a seller credit. Now, a seller credit is an amount or a dollar amount that you can ask the seller to credit you, whether you increase your purchase price to do that, or you just ask him to give you a credit, whether it's $2,000, $3,000, $4,000, $5,000. You can ask him for a credit to help offset those closing costs. And then, of course, a lender credit. We talked about that on a previous slide. A lender credit is going to give you a discount on the percentage of your actual loan amount, but it's going to be at a higher interest rate. That's where you get those no closing cost loans. Talked a lot here. What happens in the first call with me about your mortgage options? First thing we're going to do is I'm going to learn about your payment goals. Like, what are you thinking you can afford? What do you have for income? What your debts look like? What your credit profile looks like? Now, it's not going to be, the initial consultation is not going to be a full credit report unless that's decided that you want to do that. It's not going to be a full pre-approval, again, unless you decide you want to do that. But we'll just do some hand math, and we'll talk about the different options that may or may not work for you based on the information that we have. Reasons you want to maybe book time to talk to me. Again, you can book time with me by going to my calendar online right here. You can email me, you can call me. I do answer my phones on nights and weekends, but the reasons that you might want to book a time with me is you have questions that you didn't want to ask in the webinar. Jennifer, I did see your message come in, and I'll answer that when I get to the next section here. You want to understand your personal mortgage options. Again, that's that no credit check option. You're concerned about something in your credit or your finances that you think are a hurdle, and I can answer that. You want to do a formal pre-approval. You've already talked to a different lender and you'd like clarification because something confused you. I'm certainly here to answer any questions. At this point, if anyone has any additional questions, please feel free to put it in the chat. But Jennifer, to answer your question, how much can a loan approval amount differ from county to county? Well, the loan amount is going to differ based on the loan itself. Different counties are going to have different taxes. So part of that mortgage payment that we talked about is taxes. So that is something that is very important to know. So property taxes are going to determine what the loan amount could be. You buy a property in Madison, taxes might be higher than if you buy a property in Albany. Also, based on where you're looking at purchasing a property, could also determine what type of loan program that you would use. As I mentioned at the beginning, there's a USDA loan program. Now, USDA loan programs you cannot use in Madison. So if you want to buy a property in Madison, you can't utilize that program. And interest rates are based on a lot of different things. So having a conversation about what specifically you're looking for is going to make up what you can afford to buy. And so the amount is going to differ from not county to county, but program to program and tax location to tax location. If you have any other questions, certainly please feel free to book a time with me about that. Anyone else have any other questions? I just see the one question that came in. All right. So last couple slides that we have here, folks. Just a little bit about me, so you know who I am. Just a few of my online reviews. Please take a look at these. Let me know if you have any other questions. If you want to certainly search me, do a simple Google search, and either check me out by going to Mad City Home Loans. Rob Miller. You can type in Mad City Home Loans and you'll find me, but make sure you or you can go directly to my company, which is the Rob Miller Provisor Madison. That will help narrow it down so you'll get to me. Since my name is fairly common, it's easier to look me up that way. But please feel free to search me out. You can check my Google business page. You can find my online Facebook, my YouTube channels. I do a lot of education stuff, so I would greatly, greatly appreciate it. Again, thank you for your time. If you want to, certainly please feel free to scan the QR code. Let me know if you guys have any other questions. And if not, hope everyone has a great rest of your evening.